Hello and welcome to the latest Crypto Club and Digital Assets weekly catch-up on Zoom. It is Sunday the 3rd of December 2023, and as is always the case, we never know exactly what we're going to be speaking about. Really depends upon who shows up and what they want to talk about. Typically, we talk about blockchain, DeFi, NFTs, ICOs, STOs, TGEs, any other three-letter acronyms, really. And we also have a Gone in 180 Seconds session where people can pitch their projects, their ideas, to the group without the aid of PowerPoint presentations or slide decks or visuals, just speaking about what their project is. That then gives an opportunity for people to ask them questions and learn more about it. So if you're a novice, sit back, strap in and listen and learn. If you're someone who's more experienced, then do come along and join us. Or equally, if you're somebody who's got more experience and would like to share details about your project, come along and register. There's details in the link below on how to sign up for the events. So with that, let's see who's going to come and join us today. Hey, Gabriella, and hey, Daniel.
Hello.
Welcome back. Two regulars. Fantastic.
How are you doing? You all right?
Yeah, I'm okay, thanks.
Great.
Be interesting to see who else shows up today. if anybody. We never really know with these. Gabriella, how are you today?
Hello, how are you? I'm great, thank you. How are you?
I'm good.
Good, thank
Are
you.
you still in Ireland?
Yes, I'm still there.
No. I guess it's getting colder and wetter there at the moment.
Yes, damp weather, terrible. Woof
Yeah.
for me.
Yeah.
Damp
It's not
weather.
good.
Woof.
Yep. Hey, Daniel, are you continuing to still learn all the stuff about crypto and distributed ledgers and the insurance opportunities and that?
Nexus Mutual's been on my list this week,
Okay.
so I'm going to ask you about that, I think.
Yeah, good. I've not been in touch with Nexus for a while. I knew them from the early days. There's the guy who set it up, whose name escapes me at the moment.
Nick Crag? Nick. Wait, I've got it here. Hold on.
Okay. Yeah.
It is Hugh Carp. Sorry.
Yeah. So Hugh's a great guy, ex-Munich Re. So he knows insurance.
Yeah.
And it's interesting the propositions they've developed as well, because originally they were going to offer insurance propositions. I think they actually offer them as mutualization of risk, but they don't specifically call them insurance now.
Mm-hmm.
Because of the fact that it allows you to effectively take a position against a smart contract and about whether there's a bug in it or not. And it's handed out to the community for them to decide whether they pay out on the bug or not. And because it's a community decision, it's not actually technically classed as insurance. But yeah, Hugh's great guy, very, very knowledgeable, well worth speaking to. And we're joined by Peter as well. Hello, Peter. There you go. Peter's doing the 2021 thing of chatting away whilst on mute.
Yeah. Sorry, I was trying to get on my Mac, but I've resorted to my phone. I couldn't get in again.
Excellent. Must be something about Macs and Zoom or something. They don't seem to get on very well.
No, it goes as I think it's just browser doesn't support app, so I guess it's the Apple one, and then on my Mac I don't have the passwords. So anyway.
So such is life. It shows when we can't even get the basics of computing sorted out to just have a conversation. What chance do we have when we're trying to introduce cryptographic ledgers and new payment systems and all this kind of stuff? Interesting. Yeah. So anyone have any topics of particular interest that they'd like to ask about or share this week? Or should we just go down the rabbit warren of central bank digital currencies and how they're going to take the world over?
I've got one, Gary, which might be pertinent or not, and that was about the Bitcoin halving. I was reading something the other week about the Bitcoin halving is about
next April.
Easter. About Easter, yeah, which is a lot of other dates are tied in with April as well. And I thought, some coins are murmuring, and I thought I'd never really taken any notice of the Bitcoin halving before.
Okay.
But it seems to be that it drives the boom and bust cycles, or maybe not.
Yeah, I've got a suspicion that it will do less and less now. we actually talked about this a little bit last week. So for anyone who's listening who doesn't know what the Bitcoin halving is, the way that the Bitcoin protocol works and links all the computers together on the Bitcoin network and does a thing called mining, which is where it creates a new cryptocurrency. How it works is that on the Bitcoin blockchain, every 10 minutes, all of these miners, which are all these really powerful computers, compete to win a puzzle, basically, of a cryptographic complex puzzle. And whoever wins the puzzle every 10 minutes wins the Bitcoin for that block. And so when it first started off in 2018 or whenever it was, 2008, was it? It's going back now. The reward to the Bitcoin miner for mining a block was 50 Bitcoin. And that every 4 years, it halves. And so it went from 50 to 25 to 12.5. It's currently 6.25. And so roughly April of 2024, it'll drop down to 3.125. The idea is that it's intentionally reducing the supply of Bitcoin onto the market every so often. And those who understand the economics of demand and supply know that that effectively has kind of an intentional inflationary impact, I think is the right way of describing it. That if you restrict supply, that will force prices go up, providing demand remains the same. And so, yeah, every 4 years you get this halving effect. And what typically happens is that a few months before the halving, because it's known when it's going to happen, a few months before, the prices start rising. And then for a period afterwards, the prices go up as well. The problem I have is with any event that becomes so predictable in terms of prices, well, once everyone realizes it's predictable, everyone will get into it. And so what we've seen is for each cycle, I don't have the numbers to hand, that this effect of it going up before the halving, going up after the halving, has decreased a little bit each time. So I think now so many people are going to be so switched on to it and will be expecting it, that I think that the price is already beginning to build in, that kind of stuff. And also, there's another thing that people fail to recognize. Ultimately, people who are doing crypto price analysis, they're not analyzing the fundamental value of the assets underneath the crypto because it doesn't have one. Okay, it may have these crypto miners and all this kind of thing, but when you own Bitcoin, you don't own part of the network. Unlike if you buy shares in a company, you do actually own part of that company. So crypto prices are purely based on the analysis of what the market is doing and not anything underlying it. So anyone who can suss out what the market's up to has a good time on this. And so my thinking is that because everyone now knows that this time around the halving will be a certain way, I think it'll have a dumbing down effect. And also the market is changing. So in 2008, there weren't that many people into crypto. And so the impact of reducing from 50 to 25 is quite significant. Then you've got like the early adopters who've moved in. So they reckon there's something like 50 million Bitcoin wallet addresses now, but probably 40 million of them aren't used. But it does mean that, there's about 10 million active users, whatever. But the nature of them is changing. I think fewer than 2,000 wallets have got over 1,000 Bitcoin in them, I think is the number. And what you're seeing is, I think, more and more institutions are moving into the space.
Yeah.
And they behave differently. So that they don't behave like a group of kids running around who've just bought a load of pizzas with a couple of Bitcoins. And so I think the nature of it's changing, but we'll see.
Well, it's the likeness to digital gold, isn't it? The cost of mining basically goes up, so there's a floor into the price. If the price drops below, the miners stop mining, and then that introduces scarcity. That was the model behind it, wasn't it? As you say, there's no price, but there's a lot of electricity to mine a Bitcoin, and if you get paid half as much, then you're going to put your shovels down, in theory, until the price goes up.
Yeah,
So you get that scarcity with the ETFs, which might be landing, the Bitcoin ETFs for BlackRock, etc., landing about April. So supply goes down, demand goes up. And as you say, people will be getting ready for that and buying, start to accumulate in advance, maybe.
Yeah,
If it
exactly.
also burnt in the crash.
But it's interesting as well. I'll pull up a chart, and this is just one random one that I happened to look at earlier on, which kind of demonstrates this. So this is charting out the previous Bitcoin halvings. So yeah, we had this period where Bitcoin was going up anyway, and it was going down, it was going up, it was going down. Then you had this halving in, it says 2013 roughly, but around about that, where after the halving, it certainly went up quite significantly, then started decaying away, then started rising a little bit. Then you had a halving and it peaked up again and so on. So it does kind of look like there's a pattern. But I think at times people in the crypto world, they suffer from an effect called, I think it's apophenia. And apophenia is the ability to see patterns that don't exist. So it's a little bit like when you look at the sky and you can see the clouds and you can say, oh, look at that, it's a dog and this kind of thing. Yeah. I think at times it's the same with crypto charts, that people see patterns that aren't actually there at times. So
yeah, I heard technical analysis described as horoscopes for men.
Yep. It's a great description. So fortunately, we've got a nice balance here. We've got Gabrielle on for a different perspective, and also Elena's just joined us as well. So that brings us out that we've got a little bit of sanity and not just horoscope for men. It's a good point. Yeah. So it will be interesting. I've been arguing for a while that I suspect that the halving this time will not have the impact that everyone's expecting it to have, simply because everyone's expecting that behavior. So I think sometimes people outgame the market, and we'll see where it goes anyway.
It's just an auspicious event there around the equinox. We've got the halving, and we've got the ETFs, and we've got the ISO 222 go live.
So ISO 20022, for those who don't know, is the new ISO standard around payments messaging. Is probably the simplest way of describing it. So ISO is the International Standards Organization. This is the body that's responsible for all sorts of standards, whether it's things like plugs in the wall or country codes. So, using GBP for Great British Pounds or UK for United Kingdom. So ISO is responsible for all of these standards, and one of them.
ISO freight container. ISO freight. That's the famous one. They standardised the freight containers, and they're called ISO freight containers.
Yeah, and that shows the power of standardisation. That if you look at what happens, and people still don't realise it actually, containers around the world. You look at these 40-foot containers, are all part of an ISO standard, as Peter says, which means they're completely interoperable between ships and trains and lorries, that kind of thing. So they're all designed around a certain way, and that allows interoperability. So ISO, anyway, it's the International Standards Organization, does all sorts of standards, and one of them is around payments messages. And the new payment messages is ISO 20022, which there are about 4 cryptocurrencies which say that they are ISO 20022 compliant. So we've got XRP, which is the Ripple cryptocurrency. There's XLM, which is Stellar Lumens. IOTA, I think, is ISO 20022. And there's one other which I can't remember offhand. But there are certainly there are several of these. It might be QNT, Quant.
Quant, yeah. That's
I think that's the other one. Yeah. So it's interesting as well. Quant and XRP, as well as being this compliant with this new standard, are also the cryptocurrencies being talked a lot about in use with central bank digital currency initiatives as well. So as Peter says, that might lead to some interest there. We shall see. So with that, I guess you're right there. We've got, you mentioned the ETFs as well. So in the USA, the Securities Exchange Commission is the regulator responsible for securities, and that includes things like electronic traded funds, which is what an ETF is. So this is an ability to buy access to financial products without actually owning that financial product directly. So an ETF, typically, it's kind of like a pension fund in a way, that it allows you to invest in areas like, the way you do with pension funds and that kind of thing, into different types of stocks and shares. And one of the big ones that's been talked about at the moment is Bitcoin ETFs, which will be the ability to invest in Bitcoin without actually buying the Bitcoin itself. So people sometimes say, well, why would you want to do that? A couple of reasons. One is that if it's traded as an ETF, then it's a financial regulated instrument, which means you can buy and sell it through regulated exchanges, which gives you that kind of like comfort factor that you're dealing with properly regulated companies. And the other thing is that it does away with the need for needing things like crypto wallets and that effectively you can just use, a user ID and a password and go into a client's account or something. So it makes access to these things much easier.
There's another thing, Gary, with it. It's pension fund compliant. I've got one in my pension fund, so it keeps your massive gains away from the tax man.
Yeah,
just the 401s in America, or your ISA or your SIP.
You're right, and that's the other big thing, that an ETF, because it is a regulated financial instrument, means that hedge funds, pension funds, investment managers, and all that kind of thing can legitimately take out positions in these. And so what it suddenly means is that if you've got a regulated product, then that potentially opens it up to be bought by really big players. So if you look at the crypto market at the moment, which is worth about $1.4 trillion, that is tiny compared to traditional financial markets. So think about hedge funds who've got positions in like stocks and shares, and investment managers and pension funds and that. If they can start getting exposure into crypto through these ETFs, that's where there's thought that there could be a big growth. Now, it's rumored that the SEC is likely to make its next announcement on ETFs in mid-January, I think it is. There's a window of about 6 or 10 days, I think, where there's a thinking that they might make an announcement, because so many companies have applied for them now in the US. And so the suspicion is that the SEC won't want to announce one ETF and then a week later announce another ETF, because that would be unfair. So the suspicion is that they might make a big announcement about several ETFs all at the same time. I think it's the middle of January. So we'll see where that goes. So this is the thing, that we've got the Bitcoin halving in April, which typically has an impact on prices, although I'm not convinced it will do this time. Then you've got the whole thing about the ETFs. And there are ETFs elsewhere in the world already. There are some European ETFs which are available.
Bitcoin ETF, through Europe. But they closed it. The regulator, they closed it for they closed all the on-ramps.
So that's where having a US approved one suddenly opens it up to a lot of markets if that happens. So far, the SEC have refused every single Bitcoin spot ETF so far, and that they've declined them, saying that they're too risky or they're not comfortable with them. So we'll see if that changes this time.
And the Ethereum ETF too, huh? I think Grayscale got theirs knocked back.
Yeah, because the concept's pretty much the same, isn't it? It's this notion of being able to buy exposure to Ethereum without actually owning Ethereum. So we shall see. So there's several things coming along. It's going to be an interesting year, 2024, I think.
In many ways.
Yep, very true. So with that, then I'll open it up. Any questions this evening? Daniel's always good for something. Oh, Elena's put her hand up. Go on, Elena, you go first then.
Thank you. Thanks. Let's just put it down a notch and speak about Bitcoin halving.
Hmm?
For people who don't know what it is, what is Bitcoin halving, and why we don't have Ethereum halving? We don't, do we?
We don't now, because Ethereum uses a mining protocol called proof of stake, which
No
is
proof of-
different
yes.
to proof of work. Okay, so I was actually chatting to the others before on this. So Bitcoin, because of the nature of how its mining process works and how its consensus mechanism works, the quick version is that every 10 minutes, a new block is mined on the Bitcoin blockchain. So on the database. So imagine a block is just a chunk of data with, say, 2,000 transactions in it, maybe. And then there's a competition where all the miners then compete to do an algorithmic computation to solve a puzzle, and whoever gets the answer first wins the Bitcoin that's associated with that block. So originally it started off with miner getting 50 Bitcoins, then it was halved to 25, then halved to 12 and a half, and so on. So every 4 years, roughly, there's a Bitcoin halving event, which is where the protocol is updated to halve the reward for the miners. So the idea is that ultimately there will only ever be 21 million Bitcoin produced, but if you actually plot it out on a curve, that if 50 are released every 10 minutes, then 25 are released every 10 minutes, then 12 and a half, then 6 and a quarter, then 3.125, then whatever the half of that is and half of that is, then eventually you'll hit the 21 million number in the year 2140, I think it is. So it's over 100 years away. And what it means is that it just reduces the reward. And that, in theory, reduces the supply, which keeps the price maintained in some way as long as there's still demand. The other thing as well that ties in with all of this, and this is why Bitcoin and many others, the protocols are so clever in their design, is that the mining is designed for Bitcoin to mine a block every 10 minutes. And the Bitcoin protocol, so the software that's monitoring all of this, kind of keeps an eye on this and starts noticing if the computation is taking too long because there aren't so many miners involved. So Peter was saying before, if it gets too expensive to mine blocks, then some of the miners just switch off their computers because it's not economically viable in that. That then means there's less computing power being applied. And so in theory, the time taken to mine a block increases beyond 10 minutes. So it could, 12 minutes, 14 minutes, or whatever. So the protocol very cleverly adapts and makes the calculation a little bit simpler. And so it means it's constantly, it keeps checking every so often and goes, was it roughly 10 minutes? Yes. Was it roughly 10 minutes? Oh, it took 15 minutes. I'll make the calculation simpler next time, and so on. And kind of works like that over time. And the idea of that is to allow for the fact that computers get more and more powerful. There's a thing called Moore's law in computing, which, if I remember correctly, is that the power of a computer doubles every 18 months and halves in price, roughly speaking, or certainly with microprocessors. And so the Bitcoin protocol actually built all of that in to allow for the fact that as computers get more and more powerful, then it'll take less and less time to solve this puzzle. So the puzzle gets harder and harder. But equally, as the price of Bitcoin drops or the reward drops, it becomes less and less attractive to mine. And so the miners switch their computers off or they use it to mine something else. Does that answer it sufficiently, Elena? Does that make it clear?
Yes, it does.
Okay.
Thank you.
So Daniel, this is your chance now.
Right. So I was going to ask you about Nexus Mutual. And just, probably best off just explaining what a mutual insurer is, because is that what they are? Are they a mutual insurance company?
They're a mutual company. Whether you can argue that they're a mutual insurance company, because that has a regulatory connotation.
Yeah.
So in the UK, for those who don't know, you've got the Bank of England, which supervises two regulators, which is the Financial Conduct Authority and the Prudential Regulations Authority. They're kind of like finance regulators in the UK. And their scope is any regulated financial activity. So think about things like pensions, share trading, investments, banks, and insurance. So insurance is a financial regulated activity. And that means if you're an insurance company, you are regulated with the FCA and for some things the PRA. And so you have to follow certain things. There's the senior manager's handbook. There's all sorts of FCA guidance in that. And so to be able to use the term that you are an insurer has, particular connotations about being licensed and regulated, that kind of thing. And I can't remember with Nexus, I think they might be acting potentially as what's known as an appointed representative, which is where they're actually using the insurance license of another company to provide insurance. I think they might be doing that, but I can't remember. Certainly that's how it's been done with some others. A mutual insurance company, for those who don't know, and this was the same with banks originally as well, you've got things called cooperatives or mutuals, which go back several hundred years, which were groups of people who simply got together and pooled their money in some way. So they may have had like a mutual bank account or a mutual store or something, where a village would get together. They'd all put some of their money into effectively this mutual fund, which could then be given out as loans to people. So in some countries, farmers still do this, where the farmer needs a loan to buy new equipment or to get seed for, to grow for the year. The same concept works with insurance, that a mutual insurance company, and that there are still some. So I think the National Farmers Union is still a mutual insurance company, where that is made up of members who are from the farming community, who put their membership fees in, and then they use some of that to kind of insure the product. So the idea of a mutual organization is it's where as a group of people mutually contributing to something. And that's where a lot of insurance type things came from originally. If I remember correctly, with the Great Fire of London, I think was one of the things that kicked things off, if I remember my insurance history correctly.
Gary, is Lloyd's of London still a mutual?
Lloyd's of London isn't. Lloyd's of London is a legally recognised corporation. And in fact, it's interesting that there is actually a piece of legislation, which, if I remember correctly, is the Lloyd's Act, which actually provides Lloyd's to be able to do what it does. Lloyd's, for those who don't know, is effectively a marketplace and a industry supervisor. So it's a marketplace in that it has a physical building in Lime Street in the centre of London, where brokers and underwriters get together to write insurance contracts and negotiate things. So the building's still there. They've been using this current one for, I think it's 30-something years now. So it's known as the Inside Out building. It's quite distinctive. It's won various awards and that. But Lloyd's of London is also a supervisor, which is kind of like a delegated regulator. So they're responsible for the insurance business that is undertaken within the Lloyd's brand. So you'll quite often hear Lloyd's of London, and you'll see insurance brokers who are regulated through Lloyd's, and underwriters who are regulated through Lloyd's as well. Yeah, I've done a fair amount of work in that market and in the building as well. Daniel, did that answer your question about mutual insurance?
Yeah. So what I understand Nexus is doing is like, I've done a bit of work on it, and so the claims process is all incentivized. So I think you stake 10 Nexus Mutual tokens to maybe receive 11 back. That's just an example. But if the claims process is deemed, and you validated that claim, and then the claim isn't right, it wasn't covered, they are then slashed, them tokens. I think, I don't know what you know about that, but I found a good YouTube video about it where it seems really good, to be fair, really good concept, and it's quite impressive. Like, everyone seems to be incentivized to do the right thing.
Mm-hmm.
For the cover, it looks quite cool, to be fair.
Yeah, and the idea of it, remember correctly, it's mitigating against the risk of there being a bug in a smart contract. So for those who are on the call now, you'll be aware, you've got a blockchain layer, which is all the computers chatting to each other, which you've got a ledger, which is all the records of the transactions, and then there might be like a cryptocurrency as part of that. And then there's quite often, for things like Ethereum and a number of other blockchains, a programmatic layer, which is what we hear the term smart contracts. And this is where things like tokens are created. So you might have heard of ERC20, which are Ethereum smart contract based tokens, which were used for generating money to raise funds for companies a few years ago. Current one, everyone's heard of NFTs now. NFTs quite often are based on the ERC 721 smart contract standard. So the way the program is written for the smart contract. A smart contract, probably the most misnamed thing ever, because it's not smart and it's not contract. It's a bit of software. And as Peter and I will both know, because we've got a history of working in the IT sector, computer programs go wrong sometimes, either unintentionally, which is where you have a bug, which is where the software behaves in a way that was not expected, or intentionally, where you've got like someone's programmed something fraudulently somewhere. And so what Nexus Mutual did was they saw there was an opportunity that there are all these smart contracts which are responsible for things like ownership of NFTs, new crypto tokens, so massive risk if they go wrong. And mostly the traditional insurers don't really understand how these things work sufficiently in order to calculate the risk and so the premiums they're going to charge. And so they tend to stay away from it as too much trouble and not a big enough market. So Nexus Mutual, with the team knowing about insurance, set up this thing whereby, as Daniel says, you can buy, is it NXT tokens, I think it is, something, as a form of risk mitigation.
I think.
Okay, I think they've actually got two tokens. It's quite a clever way in that the two tokens are linked. I don't know how linked, but ultimately it's a form of taking out protection that if you've written a smart contract and it goes wrong, then you can recover from this fund, compensation type thing. But the reason it's not called insurance is that insurance has got certain notions around it. One of which is if it's a valid claim, then you will get paid. Whereas with Nexus Mutual, it actually goes to a community who vote on whether it's a valid claim or not. So if they say, oh, well, this smart contract's failed, it's resulted in a loss of, say, $10 million or something, but it's failed because someone intentionally wrote something in there as a scam, then that's not legit. So we're not going to cover you for that. Whereas if someone has exploited a bug externally in some way, then that's legitimate and they pay out on it. That's as much as I know about that, Daniel. But yeah, a very interesting company.
So would you term that as assurance rather than insurance then?
Yeah. So you look at ultimately the purpose of insurance is as a form of remedying a financial loss. Yeah. And this is the thing where people don't quite get it. But this is why in insurance, you can only insure about something in which you've got financial interests. So this is why you can't take out a life insurance policy on the king, for example, which used to happen many years ago, because then you could get a situation where people start taking out a life insurance policy on someone and then arrange for a hitman. And hey, press the guard claim. So you can only take out an insurance policy against something you've got interest in. That tends to be the thing. So I think you're right in a way that what Nexus Mutual is doing is not insurance, but a form of assurance. Yeah, it's a good way of thinking of it.
That's the thing with the new coins, isn't it? You've got to find things with a real world application. Otherwise, it's just speculation.
Absolutely. I don't. Go on, Daniel.
I know they're doing a piece with Chainlink. They did a couple of things on YouTube, and to be fair, that takes us into another question about Chainlink. And my understanding of Chainlink is that um, they provide oracles to the Ethereum network. I think that's right, and that's real world data to be put towards smart contracts.
Okay, yeah. So this is where Elena's going to hold her hand up and say, "What's an oracle?" Go on, Elena.
How did you know?
Okay, so in the blockchain world of distributed ledgers and smart contracts and everything, you'll hear this term oracles used. And an oracle is it's meant to be the ultimate trusted source of data. So if you think as an example, there's a company called Etherisk, and Etherisk, built on the Ethereum blockchain, they provide flight delay compensation. And again, I'm going to avoid using the word insurance here. And what they do is they plug into an oracle, which is an information source about flight details. And so what you can do is you can say, right, I'm going to San Francisco on the 7th of December, flying with United Airlines on flight United 911 on the 7th of December. You can stake a thing on Ethereum through Etherisk to protect you against that flight being delayed. And what then happens is that the Etherisk system has an oracle where it checks all the flights, and if that flight's delayed, then it pays out what's known as a form of parametric cover, which is where it automatically pays a claim if that flight's delayed, which is very interesting from an insurance point of view. Again, we're talking a lot about insurance today. I've done a number of talks at insurance conferences where I've said, have any of you ever made a claim on flight insurance? Like, loads of hands go up. And I say, oh, okay. How long did it take for the claim to get processed? And they always go, oh, it was really, really quick. It only took about 2 weeks. It's like, okay, so think about this. You've taken out a contract with Etherisk to protect yourself on a flight. And the oracle, which is this trusted data source, pinging over constantly details of what flights there are and if they're delayed or they're operated on time. As soon as that pings an alert so that your flight's delayed, then you are given compensation, which means that you don't even need to make a claim. It just happens. So oracles can be used as a trusted data source that a smart contract can monitor in order to make payouts in some way. So Etherisk, they've done it with flight delay programs and crop protection as well. So they've done it with small farmers in Sri Lanka, whereby if it rains more than a certain amount, then the crop is assumed to have been destroyed. And so they're automatically paid out insurance. And that is insurance because it's done through Aon, who are a big broking organization, one of the world's biggest. And so the idea is that if you're a micro farmer who, your living, your livelihood depends upon this field of crop, well, if there's a sudden downburst of really, really heavy rain or wind or whatever, and it destroys the crop, what you don't want to do is go through an insurance claim process where you fill in a form and then they send a claims assessor and then they get a third-party administrator and they review it. It takes weeks and weeks and weeks before you get paid because your family's probably starving by that point and you've lost your livelihood. So the idea is that they offer this crop protection insurance that pays out really, really quickly. And I think they've done it with what's known as catastrophe loss as well. So in the insurance industry, catastrophes, natural catastrophes are things like earthquakes, tsunamis, volcanoes, that kind of thing, and a lot of windstorms as well. And so, again, I think Etherisk have developed some natural catastrophe insurance, whereby if it's more than a certain level of wind or rain or whatever, then you automatically get paid claim. So that Etherisk, well worth checking out. They're a Germany stroke Austria based organisation. They were doing some stuff in the UK a while ago. And I was involved with them. Good team, nice bunch of people.
Is that what used to be classed in insurance as acts of God, which were uninsured in a lot of policies?
So you still
Force
have
majeure acts of God.
you still have force majeure. So you might have so say you've got an insurance contract to protect you against I'm trying to think of something else where it might happen. In fact, it should be Daniel who's coming up with these examples, not me. But force majeure is where something is outside the control of any party because, as you say, there's a severe weather event happened. Natural catastrophes are things that might happen at some point. And typically they're insured by what is known as cat bonds, so catastrophe bonds. So these are things that countries insure against. So, countries might insure against there being an earthquake or massive wind damage or something, or tornadoes and that kind of thing. Turning into an insurance night again, which is great for me because I happen to know a bit about that industry.
Just in terms of Oracle, I always thought when the reference was to Oracle, it was the company Oracle who did the relationship databases. Okay, it's Oracle with a small O.
Yeah. So think of Oracle back to, is it Greek history, I guess?
Yeah, Oracle Delphi. Yeah.
The oracles and Delphi was the whole thing of the ultimate trusted source of knowledge and that. So you got joined by Johannes. I didn't see you join us there, Johannes. And you put your hand up as well. Go for it.
Yeah, sorry. I joined like 15 minutes later, so apologies and good evening, everyone. I don't want to kind of sidetrack the conversation. It's very, very interesting. But I do feel kind of real world assets is what I wanted to talk about. Obviously, there's it's very US centric news most of the time, especially in this industry or like most industries. But I just wondered if you knew if there's any projects, or actually more interestingly, if there's any kind of regulation around that in the UK from more of a UK perspective, or if not, do you think it's feasible? I know the whole US Treasury bills and what DI and SDI is doing seems to be working pretty well, and there's a few other projects doing that as well. So that there's that whole kind of bridge between actual real life and the digital world. But obviously, we want like tokenization of property and deeds and etc. So yes.
So the answer to the question of is there any legislation is yes, but not specifically around the tokenization of real world assets. There's existing legislation around real world assets, and there's legislation around crypto. And so what you've got is that this is where people sometimes fall foul, that it may be if you're operating in an area where you're doing real world asset tokenization, that means you've got to comply with any crypto regulation and any real world assets regulation as well. So you won't find anything much yet, which is specifically around regulation of tokenized real world assets, but you will find regulation around property and property ownership. So in the UK, as a simple example, I think you can only have up to 20, I think it is, co-owners of a property in the UK. There's a limit on it. So straight away in the UK, you've got a challenge of tokenizing the real world asset, because if you're going to sell a token to represent ownership of the property, then you can't sell more than 20 of those tokens straight away. So that's the real world challenge. And then you've got the crypto challenge, that if you're dealing with it in crypto tokens, then that puts you within the guise of the FCA's requirements around being on the crypto asset register. So in terms of companies in this space, there's quite a few. So in the UK, you've got TPX. Tony Abel has been on this particular session a few times now. He's doing stuff around real world assets tokenization. I'm aware in terms of property, there's been well over 60 property tokenization projects that have now failed. And they've typically failed because they have failed to typically recognize that they have to cross two regulatory hurdles. The one is the crypto regulation, and the other is the real world asset regulation as well. So it depends which market you're looking at. There are companies doing tokenization real world assets in Switzerland, the names of which escape me at the moment, but there was one that was tokenizing property, there was another that was tokenizing high performance cars. There's things like BitGold, I think, which was tokenizing gold-based assets. And there's been loads of property ones as well. And there's another growth, I think, particularly in the Middle East at the moment, of a lot of tokenization of property in the Middle East. So Dubai and Abu Dhabi are hotspots of crypto innovation at the moment. There's some stuff going on there. And Chris Mensa, who is sometimes on this session as well, he's been doing some stuff which is, I think, around tokenization of assets in Saudi Arabia, which is about property and tokenization as well. So, Johannes, does that give you a bit more of a feel, some of the things?
Well, certainly, and yeah, to hear it from someone like you as well, because I've been having this debate with quite a few people in the industry, and yeah, apart from the whole kind of US Treasuries like carry trade, lack of finding a better word, yeah, it's exactly what you said. But again, I don't have that background, but you've pretty much confirmed it, and yeah, it's having to go over the two kind of regulatory hurdles. So as great as it sounds, and there's probably, I mean, the synergies there, right? And like tokenizing it on a blockchain makes a lot of sense, but
yep.
it just seems very, very difficult and not realistic, and at least in the short and medium term anyway, before we have any sort of like clear guidelines and regulations for crypto as itself.
So I think we're getting quite close to it, actually. So if you look at the guidance that the FCA has done, that in Switzerland, FINMA, which is the Swiss financial regulator, they've done some really good guidance. I think some of the US regulators are doing some good stuff as well. The other thing as well is that it's companies who recognize that there's a need to do crypto compliance and real world compliance. If they get that, then they're more than halfway through. So I was doing some work with a law firm a while ago, and they said, oh, can you just take a look at this particular project? And they didn't even tell me what the project was about, but it described a multi-company structure of having what's known as an SPV, so a special purpose vehicle registered in, I think it was the British Virgin Islands or Caymans, and a regulated foundation based in Switzerland, something. And I was looking at it and said, oh, real estate by any chance? And they said, how did you know that? I said, because it fits exactly the model of how you can overcome this challenge by having like a Swiss entity which deals with the crypto side and a offshore company dealing with the physical asset side. And so what you can actually do, and this is not financial advice or anything like that, is rather than trying to sell tokens that represent ownership in the property, you have the property owned by a special purpose vehicle, so another company, and then you sell tokens which represent ownership in that company. So all of a sudden you've overcome this problem of just having 20 people in the UK, for example. So there are ways of doing this. But the problem is the majority of projects that have tried it in the past have not done what I always advise new startups to do, which is before you start, consult a lawyer. As weird as that might seem, a lot of people, they go into this with a great idea and they get some funding or whatever. And the two things that they always fail to do is get good legal advice and get good taxation advice. And it usually stings them. It usually catches them. I've had a few calls with people where I've been able to share with them that if what they were thinking of, if they tried to do it, they probably end up going to prison. So at one point, someone actually suggested on my LinkedIn profile I should have on my what I do bit is I keep people out of prison. Because I have had several where I've said, look, what you're planning to do, I can understand it, but it is actually breaking the law in many ways. So there's that. And then the next bit is the taxation piece. Again, people don't think through, if you're doing things like tokenization of property, where do the tax liability events take place? Because the taxman's getting wise to this idea that at the moment, in the UK, if you buy and sell a property, then when you sell the property, if it's above a certain amount, you're liable for stamp duty. And so people thought, oh, well, an easy way around that is I'll tokenize it. And that means that there's no sale of the property anymore, and so I don't pay stamp duty. And HM Revenue and Customs have had a look at that and said, nah, you're not getting away with that, because that would lose them revenue.
Yeah.
So a few things to think about.
Yeah. So in terms of that, the tokenization and assets, property is complicated, as you say, and you get into land registry issues or not being registered with the land registry and stuff. But the looking at the BRICS coalition, that's growing, and they're talking about an asset-backed currency now, which will probably be a cryptocurrency on a bridge. And they'll be tokenizing. When you're talking about Saudi, I thought you might have said, because they don't have gold, but they've got oil. Mm-hmm. So you've got oil, gold-backed currency. Why can't you tokenize the oil? And it's backed by oil, or Ethiopia, or wherever it's backed by grain. So I think that's what they're looking at, a basket of assets.
Yep.
So that's a step, and that's achievable, and it probably will happen within the medium term, at least the next 5 years. It's going to be there for sure. I think maybe within the next 2.
Well, this is where when you start looking at world events, the idea of that. So the BRICS, for anyone who isn't aware, it was originally Brazil, Russia, India, China, and South Africa. So they're all major developing nations in some way. They're being joined in January by, I think it's a further 7 countries. So Saudi Arabia, I can't actually remember the other countries. I think Argentina and a few others.
No, Venezuela, not Argentina. Argentina's going to be Venezuela and Abu Dhabi. Emirates, and right. Egypt and Sudan.
Yeah, so it's as you say, it's quite a number of oil-related or resource-related things. And so this is where world economics start coming into play, that compared to OPEC, so the oil petroleum countries, which involves things like the US and various other countries and that, at the moment, the world's reserve currency, so that the currency that is used for all international trading, is the US dollar. When you introduce something like BRICS and it grows, and then they introduce their own payments currency, which isn't the dollar, then that starts threatening the way of the world of how payments are made, and that's where I think there's going to be a real pushback on the BRICS developing their own currency. And I think it will happen. You're right on that, Peter.
It's happening right now. If you see the new members, they completely surround Israel. Yep. Yeah, and they said, the US said in the Senate, if we don't support Israel, then 90% of all oil production exports will be within BRICS. Mm. And I lost a job. I didn't actually start with Saudi. I was going out to build 4 new nuclear reactors there, and now they're doing it with China. And they're not paying. It was $40 billion, $40 billion to build the reactors, and now China's going to do it. And to bypass the US dollars bit, they're doing it for oil.
Yep. And so they're
doing the direct translation services for goods. It's barter basically with a crypto. Well, they could do it with a crypto bridge and tokenize it.
Yeah, and this is where there's a real opportunity to introduce, as you say, an asset-backed currency, which could be a crypto, that underlying it is either grain or oil or coal or natural reserves or whatever, which you can then use as a payment system. Because your problem is, once you go down the route of barter, it comes down to how many barrels of oil is a nuclear power station worth, and what happens if the price of oil goes up or down, and all this kind of thing. which is, one of the purposes of money is that it acts as this intermediary way of transferring amounts and that kind of thing. And this is where, if a new currency comes into play, then that starts threatening the strength that the dollar's got at the moment of being the world second currency.
So yeah, I think it was 80%. It's down to 60 now. With the BRICS admissions, that's going to drop under half, which is, I think, why the US is thrashing about in the Middle East. And you can see now that they need Israel for the Air Force because the carriers are vulnerable now. So, and it's if they get kicked out of Israel, that whole region, the whole of Africa, the whole of Middle East, they can't get in anymore. So it's a real, And when you said about the Bitcoin with the 100 years timeline on it, I think I can't remember the book there, but it was about each currency's got about 100 years. The British pound, the Dutch guilder, the US dollar's coming up to its 100 years. Yeah. So Bitcoin's been put in as the next centenary currency.
I think the last time I looked at it, most currencies last on average 37 years. Some obviously longer. So the British pound has been around for over 100 years. The US dollar is similar, but not quite as long, because the US dollar actually only became a single US dollar, I think it was in the 1930s, because until that point it had been state-based. So each state's banks had their own dollars, and it was only through a union, and I can't remember when it was, maybe it was longer than that you had the US Federal Reserve that effectively instigated a standardized dollar. So you used to have different dollars in the US that were issued by the different banks.
Yeah.
And so that's why in the UK, we only have pound notes issued by the Bank of England or by the Scottish banks. And this is where you go into the whole thing of Scottish notes are actually not legal tender, and you get a whole rabbit hole of conversations about what legal tender means. But ultimately, coming back to Peter's point, we are heading into an area with the BRICS growing that could have a major economic impact, which is likely to lead to more trouble around the world as America gets worried it loses control. But this is where the crypto aspect is that you could ultimately have a asset-backed cryptocurrency that is used for international trade, which is where, if it's an ISO 20022 compliant cryptocurrency, that could be quite nice for that. So yeah, lots of things going on there. So,
I think the digital yuan is gold-backed now. I think the gold-backed the digital yuan.
I didn't think it was. So for those who don't know, the digital yuan is a project in China, which is kind of still sort of an experimental stage, but I think it's gone beyond that. I think they've got over 200 million users of it now. Yeah. And it's a kind of central bank digital currency that it's a government-based, as Johan says, is at CBDC, yeah. So it's a government-based retail digital currency, which means that you can use it to buy and sell things. And I think the last time I saw, the EU had over 200 million users. Similarly, in other countries, Nigeria tried it. It's not gone so well. They had the Naira, which hasn't gone down so well. And there's a couple of other countries have been trying CBDCs as well. But the EU yuan definitely is the most well used at the moment. But whether it needs to be gold backed or not when it's backed by the Chinese government is a conversation for another day. So, folks, we've had a really interesting chat. We've covered at the last part there CBDCs, world turmoil and economics. We've covered some stuff about smart contracts and oracles. Going back, we were talking about parametric insurance and quite a lot of insurance stuff as well. We're out of time, I'm afraid. We've had our hour. So I hope that those who are on the call have hopefully learned something or in fact found it of interest. For those who are watching this afterwards on the recording, hope you enjoy that as well. Hope to see you all again sometime.
Thank
Have
you.
a great day all.
Thanks, Gary.
Bye now.
Thanks very much. See everyone later.
Yeah,
Bye now.